Hello everybody, good evening. Thanks for coming to this side event at the end of a busy day, a long day. This side event is about climate finance and also about SDG17, which is delivering the Paris promise, making climate finance matter here in Marrakech, which is obviously quite a hot topic. At the moment, and will be through the rest of the week, now that ministers are here. We are going to have two discussions, just so that you know the format. In the first discussion, this side of the table, we're going to be looking at the macro picture on climate finance. And then in the second part of the discussion, we are going to drill down to look at how climate finance can be used to improve food security. I'm going to be moderating both of them. My name is Megan Rowling. I am a journalist. I work for the Thomson Reuters Foundation, which is the charitable part of Reuters News. We are a specialized news agency, and we cover humanitarian issues, sustainable development, climate change, specifically relating to developing countries, women's rights, and food security. So I personally cover some of the issues that are going to be discussed today. So we'll start with our first set of panelists. I thought it would be useful before they speak just to go through some of the big figures on climate finance. Last week, the UN Standing Committee on Finance came out with some good news about climate finance, which is that global total climate finance has increased by almost 15% since 2011-2012, from 650 billion then to 741 billion for 2014. They said that private investment in renewable energy and energy efficiency represents the largest share of that global total. So mitigation-focused finance was more than 70% of the public finance in developing countries reported in 2013 and 2014. And adaptation finance provided to developing countries accounted for about 25% of the total finance. So we're still far off the balance of finance between adaptation and mitigation that the Paris Agreement will be aiming for. So I suppose the good news is that climate finance around the globe is going up. The bad news, of course, is that it's not enough. Many people are saying that we need trillions of dollars, not billions or hundreds of billions. So in our first section of the discussion tonight, we're going to look at how to direct greater financial flows to support the global transition to low emission, climate resilient economies. And we're going to start with our panelists discussing with us some of the different ways in which we can do that. So I will just briefly introduce them. I have here James Close, who is the director in the Climate Change Group of the World Bank. Next to him, I have Nick Robbins, who's co-director of the UNEP inquiry into the design of a sustainable financial system. Next to him, Ian Parry, who's the principal environmental fiscal policy expert with the IMF. And next to Ian, we have Karsten Loeffler, who is managing director of Allianz Climate Solutions. So a fantastic selection of expertise on the panel there. So we're going to start with Ian. Ian, can you tell us what is the role of fiscal policy in climate finance from the IMF perspective?
Okay, thanks, Megan. Well, we think that fiscal policy has a key role in several different dimensions of climate finance. I mean, firstly, we think that carbon pricing in developing countries would be the most effective policy instrument for mobilizing flows for mitigation to developing countries. Because it's going to provide across-the-board incentives for investments in low-emission technologies. And we view this approach as more efficient than a top-down, project-by-project donor financing approach, because under the latter approach, there's no automatic mechanism for ensuring that the most cost-effective investments are prioritized. And we would emphasize that we think for many developing countries, carbon pricing is actually in their own domestic interests, leaving aside the global climate benefits, because it can potentially provide a large and easily source of revenues, which is especially important in countries that can't raise sufficient revenues from broader fiscal instruments due to large informal sectors. In addition, carbon pricing can generate substantial domestic environmental benefits. For example, in China, we estimate that if they phased in a $70 per ton carbon tax over the next 15 years, then cumulatively over time, that would be saving about 3.5 million lives due to less exposure to local air pollution. As regards public sources of finance, we don't think there's a compelling economic reason why these contributions shouldn't just come from general budgets in advanced countries, which is what's happening at present. Though on equity grounds, you might argue that countries with higher emissions should be making higher contributions. And in fact, if just the large emitting advanced countries would donate just $2 for each ton of their CO2 emissions, then you'd be mobilizing public revenues of about $20 billion for climate finance. Also, we think that charges on international aviation and maritime fuels are potentially appealing as a source of public revenues for climate finance, because national governments have a much weaker claim on the tax base for these fuels than for domestic fuels. In addition, these fuels are underpriced from an environmental perspective and a broader fiscal perspective. For example, airline tickets are not subject to value-added taxes that are commonly applied to other consumer products. And in addition, there are a variety of different options for administering these types of fuel charges, but we think these options are quite practical and straightforward. And in fact, had there been a charge of $25 per ton of CO2 on these fuels in 2014, that would have been raising revenues of about $13 billion from maritime fuels, about $8 billion from aviation fuels, and that's net of fully compensating developing countries for their participation in these sorts of charging schemes, which is needed because the tax base is very mobile. It's very easy for ships to divert to other ports that don't levy fuel charges to retank. So it's important that these sorts of charges would be implemented globally. And then just finally, we think that fiscal policy also has a key role to play in enhancing the resilience of countries that are vulnerable to climate change, for example, small island developing states. At a micro level, there's a variety of examples where fiscal policies, tax and subsidy incentives can be used to promote adaptive behavior by the private sector. For example, encouraging real estate development that's away from areas that are at risk from sea level rise or natural disasters, or promoting a shift in agriculture towards hardier crops. And also at the macro level, it's important to get the right fiscal policy balance. In particular, it's important for these countries to be integrating the enhanced risks of natural disasters and other climate risks into their budgeting and debt sustainability analyses. And then they also need to think carefully about the appropriate balance with, for dealing with these risks, to what extent they should be building up ex-ante fiscal buffers versus putting aside contingency funds for ex-post disaster relief, and to what extent they should be trying to pass some of the climate risks onto insurance markets.
Okay, thanks very much, Ian. That's all. That gives us lots of food for thought. We'll move on to Nick Robbins from UNEP. Nick, I mean, until recently, climate-related policies and regulations have targeted sort of the real economy, power, transport, land use, that kind of thing. It's only now really that the focus is sort of being widened to the potential for financial regulation. So how do you see that financial regulation can support and catalyze the implementation of the NDCs that are now being transformed into will be transformed into real life action?
Thank you very much, and thank you very much for asking us to speak to you this evening. I think it's very good to follow Ian and the focus on sort of getting the prices right, the importance of carbon pricing, both as a signal to the financial community, but also as a way of raising very valuable public finance. What we've been doing at UNEP through the inquiry work is really trying to answer a simple question, which is, how do the rules that govern the financial system, $300 trillion plus, how do they need to be aligned to achieve the goals of the Paris Agreement, making financial flows consistent with low carbon and resilient development, and also more generally with sustainable development. We've done that by working with financial institutions, central banks, financial regulators, and so on. And what we've uncovered is what we call a quiet revolution. Now more than 200 different measures, policy, regulatory measures, to better link banking or insurance or investment or the financial system as a whole with social and environmental realities. This has been quite a rapid evolution. I think some of the things we're seeing were simply unthinkable 2 years ago. The Financial Stability Board, largely dealing with trying to prevent financial crises, now has launched a major task force on financial disclosure to ensure that the information that financial institutions need to make choices is there. Last January, when I spoke to them, they had no inkling of doing anything about climate or environment. This is a very, very fast-moving agenda. At the G20 level, the big advanced and emerging economies, China this year put green finance on the table, and the summit of G20 leaders in September this year recognized that they need to do more to scale up green finance. For the first time, finance ministers, central bank governors of those G20 countries were recognizing this. You mentioned a number of numbers at the beginning. I think one of the things that is important is there is real positive momentum. There's positive momentum on the public finance side, in terms of private finance, the green bond market growing very, very rapidly. But by and large, this is generally less than 1% of financial flows or stocks. So green bonds issuance is less than 1% of overall green bonds. And if we're thinking about $300 trillion of assets, some of the assets that are linked to low carbon funds are generally less than 1%. So we've got a long way to go. Some things which I think we can build on, maybe 5 areas I would choose in a very simple way, try to put these under sort of 5 R's. What can policymakers, regulators help on reallocation of capital, in terms of risk, in terms of financial responsibility, in terms of reporting, and then the overused phrase roadmaps. So in terms of reallocation, financial policy and regulation can help to speed the reallocation of capital from high to low carbon areas. Green bonds, I mentioned. China in particular has taken action, as has India, to put in place regulations which help ensure that green bonds were issued in those countries have integrity and are going to green and low carbon areas. India and Bangladesh also have introduced interesting requirements for their banks to allocate to green finance. In Bangladesh, 5% of bank loans going to green finance, and some interesting refinancing facilities from the central banks. That's reallocation. Obviously, you need the market prices to be right, but also financial regulation can help to complement some of that. One thing I would mention, and maybe particularly our other panelists, is how do we use some of the transformations in financial technology to ensure that actually climate finance gets particularly to households and SMEs. So, second one, risk. Clearly, all finance is about the assessment of risk. And again, a lot of financial policy is about prudential financial policy, ensuring that institutions and the systems are safe. Brazil has been, I think, a leader here in ensuring that banks in Brazil have to look at in social and environmental risk as part of their governance. And France also will incorporate climate factors into stress tests for banks. One of the things we're doing at UNEP in December will be pulling together insurance regulators from around the world to look at sustainability questions for the first time. Responsibility, particularly for large institutional investors, over $100 trillion of assets. How do climate factors bear on their responsibility in terms of managing other people's money? A number of countries are now refining the rules around fiduciary duty to make clear that it is part of prudent practice to take account of some of these material climate factors. South Africa and USA, interestingly, amongst the leaders there. Reporting, I touched on the FSB, very key area. One of the things I think that is now coming through and is very much as a result of the Paris Agreement is the need for companies and financial institutions not just to report last year's climate performance, how many emissions and so on, but actually start giving forward-looking guidance about how the transition to resilient and low-carbon future will impact on their business models. And that's a very, very new departure. And I'm sure Carsten will tell us more about that from a financial perspective. And finally, this area of roadmaps. We've been working in a number of countries trying to see how do you get an overall view about the financial system, the banks, the insurers, the stock markets, the investors, the regulators, and so on. China's probably furthest advanced. They've issued guidelines for a green financial system, but also Italy, interestingly, bringing together these actors. And what we see is a community of practice coming together, often people quite fragmented. And this is the sort of platform that can help with the NDC. So I think momentum is there. We have some tools for transformation, but maybe some big challenges. Obviously, we've got to do this at speed and scale. We've got to think a lot about capacity of financial professionals and policymakers, financial culture, and then crucially think about access to finance for households and small businesses. Thank you.
Thanks very much, Nick. Before we move on to ask Carsten about the private sector, we're feeling a bit lonely down at the front here. If anyone at the back would like to come forward, that would be great and make us feel a bit more loved. So I'll let you do that if you wish to. But Carsten, as Nick said, you are our representative here of the private sector. And so I guess what we'd like to know from you is how can private sector actors, especially in the finance sector, help further those policy and regulatory reforms Nick was talking about, so that we get the kind of transformational change that we're going to need if we're going to be dealing with climate change effectively?
Yes, thanks very much. I think from an institutional investor's point of view, and that is what Allianz, beyond its core insurance business, is with roughly 650 billion euro insurance money to be managed on a daily basis. It's about three major points I'd like to highlight briefly. It's first, understanding regulation and the business case of regulation. Secondly, being vocal in respect to what is good regulation. And thirdly, it's about acting. And what that means, I will highlight a little further, a little later. To the first point, understanding the business case of regulation. It's very much about cost effectiveness, and it's about creating a level playing field. What I mean with that is that it's important for private sector actors that the forerunners do not remain alone. So we have to be accompanied by the entire sector. So in that respect, it's very important to have this in mind. We see some restrictions in the delivery of long-term goals woven into the financial system. Some myopic regulations might hinder longer-term perspectives. While we are, as an insurance company, naturally coming with a long-term perspective, in some cases it's not that easy to deliver on that target. So, and thirdly, to the point of understanding regulation, of course, it's about correcting inefficiency of markets. And we already listened to Ian, in particular with respect to carbon pricing. From a very agnostic investor's point of view, just to play this card, it's just as simple as that a portfolio manager understands a price on carbon and can act on a price on carbon. So there is change inevitably coming with a price on carbon. And to my second point, being vocal. What I mean with that is being part of the discourse. just reaching out to different communities, talking to regulators, talking to peers, but talking to civil society as well. Because we are not alone. We only can deliver together. That is well understood. And in that respect, we experienced in the past by, for instance, working together with WWF, what the actual challenges are. So there's a huge learning curve for us as well in the climate ambitions. And that led to different activities like supporting carbon pricing, like supporting phasing out of fossil fuels, like the importance of reliable feed-in tariffs or similar mechanisms, just to name a few. But most importantly, and this is a third point, it's about to act. And our perspective on acting is very clearly comes with a perspective of a long-term investor and a universal owner of assets. And what I mean with a universal owner is very simply that we own part of the global economy. And it's just impossible to be smarter, to outsmart all the other actors on financial markets. So we will be impacted by any economic shocks that might come from climate change. So in that respect, we have a natural interest as a long-term investor and as an insurance company in order to get the climate challenge solved. But what is important in that as well is that what we do has sometimes a signaling effect and is a learning exercise. And with respect to that, I just can briefly highlight a brochure at the second annual progress report of the Portfolio Decarbonization Coalition. It's a collaboration of very different investors of very different constituencies and size, working all together and sharing knowledge on one common target, and that is decarbonizing portfolios. Having said that, and coming back to Nick mentioning disclosure, we see this is inevitably coming. And this relates back to standards, what I mentioned earlier, and to a level playing field. So what we see in terms of the task force on climate-related financial disclosure, this is very likely to become the new standard a few years down the line. It will be for our own use in order to understand better climate risks, and in particular, forward-looking risks. We're not that much interested in carbon footprinting. That is nice, but it's backward-looking, and as an investor, you tend to be forward-looking. But it delivers transparency as well, and I can, of course, understand civil society's approach of us wanting to be as transparent as possible. And I think that is the way things will go quite naturally. And maybe last but not least, Ian alluded a little bit to the insurance side of the business. Insurance regulation, in particular in developing countries, but not only in developing countries, is pretty important to deliver insurance solutions that are linked to natural catastrophes and to bridge the protection gap that we see in many countries with very low insurance penetration rates. And it's not just about transferring risks, it's embedding it in a larger context, meaning understanding risks in a local context and finding out what are risk reduction measures that can be applied on a community level, on a regional level, on a state level. And then it's about risk financing, but it's only the third step. And one solution we might provide, and that is risk transfer, i.e. insurance. Thank you.
Thanks very much, Carsten. That's great. We'll move on to James Close. He and his team manage over $10 billion of climate funds, I understand. So I think you're a very good person to explain to us how we've talked about the high level of finance and regulations and so on. But I think it's important to a lot of people here to understand how we can use that climate finance to support the people who are worst hit by climate change, the people who are the poorest and the most vulnerable. And I think the World Bank obviously has a good take on that, given that your president is often talking about the necessity of doing that. So let's hear from you, James. Thanks.
Is that better? Yeah. Okay, very good. Thank you very much, Megan. And just to throw around another couple of numbers, at this time last year, we presented the Shockwaves report, and that talked about 100 million people falling back into poverty if we didn't deal with climate change falling back into poverty by 2030 if we didn't deal with climate change. This year, we've launched another report that goes exactly to your point, Megan, called Unbreakable, and we launched that yesterday. This is a report that looks at the impact of natural disasters. It takes 117 countries and assesses the impact of those disasters on those countries. And we've come up with an estimate, this sort of bottom-up estimate, that this costs $520 billion a year. It's about 60% more than we perhaps thought in the past. And 26 million people are put back into poverty as a result of these disasters. So we know we need to make the system stronger, and we need a systemic approach to all of that. And I think Ian and Nick and Carsten have talked about specific aspects of all of it. But I'd like to talk a little bit about what the bank's doing on the ground to enable that systemic approach to come into place. And I think in many ways, I'll preface my conclusion now so that you can listen to this in the thoughts of whether actually this description does justify that conclusion, which is we've got a lot going on, but it really does need to be more connected if we're to build resilience at scale across the poorest and the most vulnerable. So if I give you the first example, the Small Island States Resilience Initiative that we've put together helps small islands plan for the impact of climate change, whether it's rising sea levels or increased typhoons and hurricanes. And our prognosis of the problem there is twofold. One is that there's actually a reasonable amount of finance available. It's just very, very fragmented. And it's also, that problem is exacerbated by the fact that for many small island states, capacity is really rather limited. So the work that we're doing is to try and build capacity in those small islands to enable them to access the finance that's available and put together programs that are really going to enable them to build that resilience. So the second area I'll talk about is on the side of insurance. We've been working a lot on insurance in the past, and we were given a shot of adrenaline in Paris through the Ensure Resilience program that the G7 promoted and funded. And I think insurance is a tremendous way of identifying risk, managing risk, and reducing risk. And some of the insurance schemes that are being put in place now enable the poorest and the most vulnerable to get access to insurance that enables them to avoid the losses that arise as a result of, for example, reduced yield in crops. But it also enables the insurance companies to send through the information that enables farmers to decide when they're going to harvest or plant those crops so they can reduce some of those risks. And when we build these systems in an integrated way, we really enable that resilience to be built up from the insurance products themselves, the information that flows, and also the way in which the money is dispersed. So, for example, in many countries now, you can take out your premium on your mobile phone, you can be alerted to the weather event, you can confirm that the weather events happen, and the money can be transferred into your account as a result of that. So creating a closed loop system for insurance. The other activities that we're undertaking around this relate to early warning systems. So we do a lot of work on early warning systems, and the climate risk early warning system that was promoted in Paris has come into place. There's a trust fund, the Cruise Trust Fund, that has funds and has just committed to its first 5 projects. And building a systematic approach to early warning enables countries to anticipate and predict the kind of weather events that are going to cause them major problems and difficulties. We've also, and if many of you who've been here for a while, it'd be very difficult to miss any reference to the World Bank Group Africa climate change business plan, because this has been very high profile. And this also starts to bring the business case for investment in Africa in resilience, whether it's through coastal areas or whether it's through savannas and drylands. And that kind of resilience building through our concessional finance supported by the investment of others enables countries to think about how they build that resilience into their approach. And we just today launched the MENA Climate Action Plan, and that features quite a lot, as you would imagine, in MENA, the Middle East and North Africa, for water. I mean, water security and scarcity is a major problem, and getting funds for better, getting finance for better management and prediction of water use can be very valuable, and that's something we've committed to in the MENA Action Plan. And the last area I'll mention is the Forest Action Plan, and forests are essential to addressing the challenge of climate change. We need to preserve the forests we've got, and we need to extend forests that have been depleted and deforested already. So there's a lot of finance flowing through RED and RED Plus programs, but it needs investment to enable that to happen. So we're working through building capacity in the countries to enable them to put together readiness programs, the kind of investments that are appropriate to support that, and then in the longer term, the RED Plus payments that go into the local communities. And again, I think just a sort of softer side of resilience building and how it links to finance is engaging with local communities and indigenous people to enable them to have a voice in this kind of activity. And very often in our work, we find that indigenous people already have many resilience measures that we can take, learn from, and bring to scale. So as you can see, there's a lot going on in enabling finance to flow and building resilience. We've got a range of financial instruments, from the really quite innovative insurance type products to a much more traditional concessional finance and grants for capacity building. And I think the challenge, as I previewed earlier on, is to bring this together in a really holistic way that enables us to increase the impact of this work to ensure that aren't adversely affected by climate change, and we're building the resilience into the system that enables them to avoid some of the shocks that we've seen in the past and we're inevitably going to see more of in the future. Thank you, Megan.
Thanks, James. It's really interesting to hear about all those different programs that you have to help the poorest and most vulnerable, but the funds have got to flow and at a higher level. And I was just wondering, I mean, it was interesting to me that, Nick, you said only 1%, I think, of all the finance that's washing around the world is going into climate finance at the moment. But you also said that you've noticed a big difference in the framing, the interest, and that aspect of things. So I guess I'm just interested to know from our 4 panelists, do you feel that we are now going to pick up speed when it comes to shifting those financial flows towards low carbon, climate resilient development very fast? Or do you feel that we might now, given what's happened in the United States, enter a period of uncertainty? Do you feel that investors, that the markets might be put off this trend at all? Or do you feel as if, the momentum is there and investors are just going to get on with it anyway? Sorry, I'm a journalist, so I always have to bring these elements into the conversation, but just interested in your views on that, because, we see there's a trend there, obviously, but it's not fast enough, and, financial markets don't like uncertainty. So any of you welcome to respond, your feelings on that, please.
I think all the pieces in place. I mean, what we've seen both in industrialized and in developing countries, that most of the energy is now coming at the national level, because I think people are seeing that the climate agenda does fit with much bigger sustainable development issues in terms of economic recovery, growth, jobs, and so on. So I think it's fairly resilient, but we're at a relatively early stage, which is why the numbers are quite low. One of the issues is actually about measurement. Actually, we have very poor data in terms of flows of finance. The climate finance data is getting better, but actually how much of the $130 trillion in the global banking system is aligned with climate targets, we simply don't know. So I think we have an issue about getting the data right. I think we have a lot of latent demand now from institutional investors for green assets. So efforts like the World Bank have been doing in terms of growing green bond markets. I think there's more to be done there. And then I think now central banks and financial regulators are ready to intervene where it's necessary. I mean, obviously they should be very cautious in what they do, but I think they're now ready again, both in industrialized and developing. So I think it's our fault if we drop it, I think, I would say.
Okay. Anybody else like to come in on that?
Well, just to emphasize that it's kind of like it's a very difficult question to answer. I mean, on the one hand, you can be very optimistic that carbon pricing schemes are proliferating rapidly, much more rapidly than we might have anticipated a few years ago. I mean, I think over 40 national governments have some form of carbon pricing, over 20 subnational governments. We were doing technical assistance in Colombia. They've introduced a carbon tax proposal as part of a broader fiscal reform. Jamaica was interested in carbon pricing issues. Seychelles is interested. So there's a lot of both, and of course, China as well is moving ahead with carbon trading next year. But even when China, assuming it implements carbon trading, it'll still be the case, despite all of these programs, that about 3/4 of the emissions won't be priced at a global level. And currently, emissions prices are typically well below what's needed. I mean, typically $13 per ton or less in the trading systems. So, you know, we are getting policies in place, but it's just, we're just scratching the surface. There's an awful long way to go in scaling up these programs. I might just quickly add that we think that a possibility to help push this momentum at an international level would be for policymakers of a willing coalition of countries to now think about coordinating over a carbon price floor arrangement, which provides some degree of protection against competitiveness issues, but allows a lot of flexibility for countries. If countries, for fiscal or domestic environmental reasons, want to set higher prices, they would be free to do so. But putting a floor under carbon pricing across a group of large emitting countries and progressively raising it over time, I think would help push this process forward.
Okay, James, Carsten?
Yeah, I think I'd break this into two parts, really. One is the finance for mitigation. I mean, the rate of price decrease for solar and the viability of solar financing makes it, you know, competitive in its own right in many jurisdictions. And certainly if you take away fossil fuel subsidies and if you start to impose a reasonable carbon tax, then, you know, that will be the tipping point for the financial system. The investment will go into renewables and clean energy. The second area, I think, is a bit more difficult, which is for adaptation and resilience. Now, you know, at one level, this investment has to be made, whether it's through domestically mobilized resources, public-private partnerships, or individuals building their homes and houses. The incremental cost then needs to be funded to build that resilience. And I think that's when development finance can play a role in blending nicely with adaptation finance. But the thing that I think is really important around all of this is getting a bit more accuracy on measurement. So how do we know what's required in terms of increasing the cost for adaptation? And what do we know, how do we know how much we're improving the resilience of a country through the implementation of the NDC and the adaptation programs those countries have? And if we can do that, then we can make the case for this adaptation finance to flow, I think.
Okay. Carsten, do you have any comments on that?
Very briefly, from maybe more a philosophical point of view, so if your working hypothesis is that the climate challenge is not very likely to go away, then I think there's a natural interest by maybe more or less all actors to try to get to an orderly process. So having said that, my basic assumption is that we will see on the technology side quite a push that, irrespective of any short-term politics, will pave the way sooner or later. I don't have a crystal ball here, but the basic assumption I see is that more resilient economies and more innovative economies are more likely to flourish. So, and maybe that's an incentive to make the own country great again.
Okay, thanks very much for those comments. I'd just like to open up the floor now and ask the audience if anybody has any questions for our four panelists here. I don't know if we've got mics out there. Yep, okay, I've got one at the front here. Please, if you could just obviously introduce yourself, that would be great. Thank you.
I'm Eric Beckwith. I'm the CEO of Freighterra in Vancouver, BC. One of the things that I'm seeing at this event is I'm seeing a small number of really, really excellent new technologies that, once they're carefully vetted, of course, and checked, have the potential to seriously help the whole situation. But it's very hard for them to actually get to finance. And so we need a better mechanism for actually vetting those things and getting them to, I mean, I'm emailing my contacts at the World Bank and saying, look at this, be sure to check this. But we need a better mechanism than that informally. So because these are breakthrough technologies, and some of them are market ready and some of them are still at the stage where they would still basically be venture. But we need to be able to use them, because one idea like that totally changes both the economics and actually the carbon methane, the budgets, the whole thing. So we need a process for that.
I was just wondering, what kind of technologies are you specifically referring to there?
Oh, very specific. One is a carbon capture technology that replaces steel and concrete. So we start to build the buildings actually out of a new hybrid material, which is a core of granite, and then it's carbon fiber on both sides of it. It's flexible, it's portable, widely applicable in industry, and it's based on a biological process in salt water, so it doesn't replace other agriculture or something else. And another is a whole new way of dealing with sewage. We take the sewage out of water and it becomes a biofuel and it stays out of the atmosphere. So those are two things that should just be funded, because they're not, one of them is totally ready, to be clear, one of them is totally ready to fund. It's been proven, it's in 8 countries now, it's good. The other still, you do due diligence and make certain there's another technical problem with it, but those are the kind of things that should bubble up to this level.
Okay,
good.
Thanks very much. Do we have any other questions? I can take another one or two. Yep, one over here. And then the panelists can come back.
Hello, thank you very much. My name is Anne Bickel from the University of Darmstadt, and I have a question maybe directed to Mr. Close, because you talked a lot about there's a lot more to be done. We have to be more connected in that, and I wanted to ask how you also incorporate these, I don't want to say new funds, but the Green Climate Fund and the General Environment Facility, which are named in the Paris Agreement as a main tool for financial redistribution, into this getting connected and maybe exchanging your experiences.
James, do you want to take that one, and then whoever would like to answer the other one?
Yeah, great. I mean, it's a great question. I think you know, the risk of proliferating funds and making them more difficult to blend and work together is really quite high, and I think the impact really comes from scale. IDA, our fund for the poorest, was $50 billion for 3 years, and finishes in the next year, and then will be replenished with, you know, hopefully something more money. And you know, what we're doing is we're leveraging that further, so we get more for it. And of course, our commitments of 28% of our lending being climate lending means that there's a lot of firepower associated with that. And the art of it is to blend these funds. The GEF, the Global Environment Facility, many projects for that grant funding have been started with GEF money. GCF's still quite new, and we're obviously working with them very hard. But of course, all of this concessional finance is going to be nowhere near enough, and therefore we're going to need to find ways of making pathways to private finance. And I think that sort of reflects the second question, which is, what do you do in incubating these things so you don't pick winners, but you accelerate the route to market? And I think we've got a side event tomorrow, which is going to be on our climate innovation centers, and that's exactly what we're talking about there.
Would anyone else like to answer on financing for technologies in particular?
Yeah. I mean, you're quite right. I mean, I think we need to think carefully about how to scale up policies on the research and innovation side. I think the US spends only about $4 billion a year on clean energy research and development, and I think something roughly comparable in the European Union. And I think seems to be a fairly strong case for gradually scaling that up. You can't just suddenly double it overnight, because you need to wait for a increased supply of scientists and engineers, or else you just crowd out research and development in other sectors of the economy. But a gradual increase in funding for basic research and development, both in major economies, seems to make a lot of sense. And then in addition, we need to think carefully about how to design policies at the deployment stage. I mean, we would favor pricing-based instruments, subsidies, because they can better handle the uncertainty. You don't want a regulation that forces a technology and then it turns out the technology is a lot more costly than you anticipated. So we think subsidies are a more flexible approach there, but then we need careful rules for phasing them out over time. We don't want them to become permanent.
Okay, thank you very much. I think we're going to leave the first part of our discussion there. I hope everyone's got a bit of stamina left for the second part of the discussion. We've looked so far at ways of raising more climate finance and channeling it more effectively to the poorest. And so now we're going to take a look at how we can actually use it for a specific purpose, which is to improve food security and help small farmers deal with that they face. So we want to look at how to use some innovative finance approaches there, and how we can improve the efficiency of investments in the agriculture and land use sector. We know that adaptation finance is scarce, and so it's an important topic to look at how we can make better use of what we actually have to spend. So we're going to look at that, and then afterwards we'll throw the discussion open and see how we can bring the macro and the more micro pictures together, and hopefully hear some creative ideas as well from the people in the audience. So I'm just going to introduce our next speakers. We have Margarita Astrolaga, who is the director of the Environment and Climate Division at the International Fund for Agricultural Development, in the blue there. Fairly obvious. We have Carlos Scaramella, who is the Deputy Regional Director of the Regional Bureau for North Africa, Middle East, Central Asia and Eastern Europe for the UN's World Food Programme. And then to my far left, we have Conrad George, who is Natural Resources Officer at the UN Food and Agriculture Organization. So I'm going to start with Carlo. From WFP's perspective, what are some of the more promising areas of climate finance when it comes to food security and humanitarian action? We heard a little bit about what the World Bank thinks, so in that area.
No,
how about WFP?
Many thanks, Megan. And I think that the first part of this session has been extremely interesting. I think to provide the big picture of how things are moving, and what we learn is that the momentum is there, that many actors are looking at solutions, but there is a recognized outstanding issue of speed and scale. There is an outstanding issue of access, how to make sure that those in need, in fact, gain access to finance. And there is an issue of a protection gap. And I would say there is actually a widening protection gap in light of widening poverty in some of the areas in which an organization like the World Food Programme operates. So if we translate this and bring it back to the title of our session, which is basically regarding SDGs, I would say that the lack of sufficient climate finance and the lack of speed and the lack of scale is going to impact on our ability to deliver on SDGs, particularly SDG2 in many countries. So this is, I think, a general consideration we need to make. I think we need to reframe the discourse on climate change, getting out of the technicalities of what it is and try to translate it in the impact of inaction. What is it going to look like? The fact that we are still discussing ways of delivering assistance and how much assistance needs to be delivered, and how much financial capacity must be made available at a time where we see clearly the signals of what happens if there is inaction. So that's the first consideration, and I think it's a starting point for my comments. I have, if I find them, 4 points to make, and I will start with that exactly. That first of all, it's very clear that there is a need to increase climate finance flows to the most vulnerable countries and the most vulnerable people. We need to realize that we are faced with a changing risk landscape. The world is becoming more complex, more precarious. We have many risk drivers that relate to food security. And not only that, what happens is that if we don't tackle some of these risk drivers just escalate. In the region I'm looking after now, Middle East, you have a country that did not manage well a response to a drought-induced crisis, and that escalated into a conflict, and a conflict that then escalated into a regional crisis. So the point is that we need to place into context climate impact, risk management, and governance aspects, and then the escalation of this into peace and security issues and human security issues at scale. The second consideration is that WFP works in 80 countries. We deliver to roughly 80 million people currently directly on a yearly basis. And I would say that we have, let's say, we are witness to the fact that early action, early warning, informed risk-taking, decision-making have an immediate positive impact on people's livelihoods, on people's ability to cope with shocks and disasters, on people's ability to retain a resilience. And therefore, there is evidence of that. There is evidence of the fact that anticipatory action lowers the need and the cost for humanitarian assistance and preserves development gains. The third point I would like to make, more positive, is that there has been a real evolution over the last period in relation to forecast-based financing and risk transfer mechanisms. So we are witness to that, we welcome that, and we've been part of that process. And just to give an example from the angle of WFP, what WFP has produced, we've been working at different levels in this ambit. One of the areas, and let's say the progress we have contributed to establish has been ARC. ARC is a facility that now is managed and owned by the African Union. 30 countries are part of it. It is a weather index-based insurance facility that is currently working. It's going to be scaled up to other actors in other parts of the world. Institutionality, so at the regional level, ownership by big, important regional institutions. Secondly, we've been assisting by making available and facilitating access to adaptation fund resources to countries. So we have a number of countries that are benefiting from this. We are implementing activities through adaptation fund programs and projects. Thirdly, we established internal systems like there's a system that was launched in COP21 in Paris called Food Secure. It's a system that helps, let's say, target beneficiaries, anticipate and manage risks, and supports them do a transition of, let's say, through the shock. It is aiming at establishing a fund for over $400 million and to become available to a number of vulnerable countries and communities. So this is to say that there is no limit to creativity. We can establish functional and functioning systems at different operational level, global, regional, country level. We can make that work. Is that sufficient? No. Do we have sufficient cash flow? No. Do we have sufficient institutionality to make that happen? No, we don't. Lastly, one point which I think is very important is the fact that, as I was saying before, we need to frame the climate discourse and the vision of our climate finance as part of a broader risk management governance systems owned by countries and by regions. Because climate is not independent from other risk drivers. It actually intersects with many other risk drivers. So it accelerates urbanization, it accelerates desertification, it accelerates migration, it accelerates crisis across the board and across frontiers. So we need to understand that we cannot act on climate without understanding the context on which climate will impact. And this is very evident in the region in which I am operating. And that means that we need to establish systems that are risk informed and that presuppose coherence from governments, but also from donors and from the various actors that operate at that level. There are positive notes about this. There are important headways that have been made in linking this type of challenges to solutions that are nationally owned, that are linked to the ability of governments to scale up and scale down safety nets. And I think one example is certainly coming from Ethiopia. It's an example that WP, together with other partners, World Bank and others, has assisted in establishing is the poverty safety nets run by the government of Ethiopia. And I think that is a reference. It's a reference for African countries, it's a reference for other countries, it's a reference for, I think, collegially all those who want to intervene in this ambit. Thank you very much.
Thanks, Carlo. I mean, you've pointed to the fact that we don't have enough funds around at the moment, but there are innovative ways of sort of getting around that problem. Margherita, I mean, leveraging non-climate finance with climate finance is, has been shown to be a good practice to multiply the benefits of using that climate finance, although perhaps it's still an area in which we're learning. I was wondering if you could speak to us a little bit about what are the pros, the cons of doing that? What do we know? What do we not know? IFAD's expertise in that area, please.
Thank you, Megan. Well, for us, working with smallholders and with the supplementary climate finance, we have been able to achieve a lot, because in the beginning, when we had all these non-believers on climate, we could bring the grant on top of our loans and say, okay, we are going to give you the money to start innovating and trying different practices to improve your resilience to climate change. The smallholders could understand easily what the problems climate change is bringing to them, but not necessarily the governments we lend money to were ready to understand or to accept that they will lend money to do climate. So these years that we have been implementing the ASAP program, the Smallholder Agriculture Adaptation Program, has given us the opportunity to show to at least 44 countries around the world of the developing countries how important climate is and what kind of innovations and difference they can make if they invest a little bit in improving the resilience. We have been able to show how they can reduce the risks and the threats that climate poses to them through a lot of different practices that have been mentioned here, like early warning systems that are key, like preparing climate scenarios before even deciding on the investment in the location, through more efficient irrigation systems. So that money that we have invested to blend with our loans has been of immense importance for us. We have also been able to do meaningful stakeholder engagement that also, again, the governments were not so convinced that was important and that we should be doing it with the loan money, or policy development. And we have been able also to promote a lot of research on new tolerant crops and to deal better with excessive salinity, with drought, with flooding. However, and I think in the previous panel, some very great ideas were proposed. I was thinking, if what Ian said happens, we will be all dancing for the next COP or the next two COPs, because what the problem is when we give them so much supplementary funds is that, in a way, governments feel they don't have responsibility to allocate any funding from the national budget to climate. Because look, these people are going to bring me in a silver platter all the money I need for climate. So why should I make an effort from my own funding? But also what Ian said on the responsibility of the ones with the higher emissions. So if we could really be serious in a transparent manner and charge all those that are producing higher emissions and complement these ones, because we see in Africa, it's only 4% of the greenhouse gases. And we see how vulnerable our millions of stakeholders, of smallholders are. So who is paying them back for these emissions to help them adapt and be more resilient? The other problem we have is that there are no efforts to, again, go into pricing, this time not of carbon. But if we are making this effort to get our smallholders to produce in a sustainable manner, to use climate smart agriculture, to use less inputs, to be more efficient and more sustainable, is their produce going to be paid properly at the right price? Or are those subsidies that we are giving others, I'm not going to go into the details, but is really promoting then this good behavior and these good practices? Or they cannot even reach the markets and nobody will really buy what they are producing after so much effort. So we also see that another problem is that we are not then obliged to make the business case for the private sector to get involved. And we see Alliance here is involved. And we feel proud to see that there are others that are making the effort. But how do we engage private sector to really feel part of the solution? Because we, in the environment sector, have been seeing the private sector as part of the problem for many years, as we see the agriculture sector as part of the problem. So how do we really make the private sector see the business case to really get involved in helping us finance this climate smart agriculture and this more resilient agriculture of these millions of smallholders around the world? But definitely, we need the money to come from somewhere to be able to support them. Thank you, Megan.
Absolutely. And I mean, I think, as you say, there are competing areas that need finance. And as you just asked the question, how do you convince the private sector that putting money into food security, into livelihoods, into agriculture is the best thing to do? So I'm going to ask Conrad from FAO to explain to us, what makes the investment in sustainable and climate smart agricultural development so important relative to investments in other sectors? Why, for example, would the private sector want to come and put their money here rather than somewhere else? And how can it be transformative? And what are the gaps and the barriers and the problems that would prevent investments being transformative? So I guess I'm asking you to pitch a little bit for more investment in this sector. Why is it a good investment?
Well, thank you, Megan, and good evening, everybody. Thank you for being here so late on a Tuesday evening. But I think this is an important subject, and I'm happy to be here on such a distinguished panel. From our perspective, we consider that investments in the agricultural sectors, and by that we mean agriculture, fisheries, and forestry, have the potential to be transformative in a way that many of the other sectors cannot. They have such a wide range of benefits, and moreover, they really target the poor people, or the people that most in need of help. So what are some of the benefits from well-targeted investments in the agricultural sectors? Well, firstly, we think that these investments enhance resilience of the agricultural production, and thus protecting incomes and the food source of rural poor. They also have the potential to increase food output and availability, which is vital to long-term food security. FAO estimates that the global demand for food will rise by about 60% by 2050 compared to 2005 levels. So that just shows the magnitude of the issue. Increasing agricultural output and incomes in a changing climate, particularly amongst the poorest, provides an opportunity to drive growth in the sector and to generate additional employment opportunities for landless poor. And again, here it's important to note that over 75% of the extreme poor, those under $1.25 per day, live in rural areas, many of whom are dependent upon agriculture, either as producers or as workers on farms. We think these kind of investments can also contribute to sustainably managing natural resources, such as land and water. And these are essential to agricultural production. Agriculture accounts for 70% of global freshwater use. We think these sort of investments also empower vulnerable groups, such as rural women and youth, and they are some of the most marginalized people amongst agricultural producers. And finally, these investments have the potential to also mitigate climate change by enhancing sequestration in soils and easing the expansion of land use, thus driving deforestation in countries. And AFLU, or agriculture, forest, and other land use, is responsible for 1/5 of current global emissions. So it's an important source. So when you factor in all of these potential benefits, we see that investments in agriculture really have a significant role to play. And we think it's really important to see that there's growing recognition of this role of the sectors. And you can see it in the prominence of the agricultural sectors in the INDCs and the NDCs that are submitted by developing countries. Just to take a couple of high-level numbers, 85% of developing countries included mitigation in LULUCF, or land use change and forestry, and agriculture. And more than 90% of developing countries included adaptation in the agricultural sectors. And these are the key documents that countries are putting forward. So from this, you can really see the role that countries want these agricultural sectors to play in climate finance. And I think significantly also now the Green Climate Fund, which is the financial mechanism of the Framework Convention, is also starting to disperse funds, and 14 of the 27 approved projects are actually for the agricultural sectors. So we think this is an important development and something that we think needs to continue. I also wanted to address what we see as some of the gaps and the barriers that need to be addressed to seize the transformative potential of the sector. And it's worth noting that 84% of the world's farms are smaller than 2 hectares, and these farmers are the main producers, main investors in primary agriculture. So it's really important that we try to change the patterns of investment patterns of these smallholders. And we think there are several things that can help to unlock this potential. Right now, farmers lack, and this has been sort of addressed slightly before, access to affordable credit, credit insurance, and other financial services, because they often have no collateral, they may have no credit history, little financial literacy, and because the costs of serving this group, because they are so physically dispersed and because loan volumes are low, are actually quite high. One of the other key problems is that most credits expect returns in relatively short periods of time. And we know that the agricultural sectors require time in order to go through this transition period during which productivity and yields may actually decline before they then increase over time. So we believe it's important to unlock these barriers and to shape investment decisions to ensure that we can actually invest in sustainable and climate smart agriculture. So we think it's important to support lenders and financial service providers, and that may be through public-private partnerships or other mechanisms to extend credit and insurance to smallholder farmers at affordable rates. We think it's important to provide the right incentives, and I think this was addressed earlier at the panel, by eliminating subsidies, for example, for synthetic fertilizers, potentially providing payments for ecosystem services. It's important to provide extension services and training to improve producers' understanding of what are sustainable and climate smart practices, and also to develop the right enabling environment through integrated land use planning. So these are just a few examples of what we consider are the sort of catalytic type of interventions that are necessary to unlock the potential of smallholder farmers and to tap into the transformative potential of the sectors. So in closing, we see that underpinning the Paris Agreement with action is now one of the central foci of the discussions here in Marrakech. I think this is really clear, and it's really important that finance flows to support this action. Given the proportion of NDCs that refer to the agricultural sectors, and given the range of benefits, some of which I've highlighted today, that investment in agriculture can bring, we consider that these sectors must be a major part of the climate investment portfolio going forward. Thank you.
I hope everyone's feeling convinced after that. Thanks, Conrad. I think as it's getting late, we'll ask the audience, if they have questions for our second set of panelists, and then, we have two. That's great. If we could get microphones to them, if you could just introduce yourselves, please. Oh, three. I've got another one at the back there. We'll take those three questions, and then you can come back on those as appropriate.
Hi. Hi. Gabriela Merla, and this is a question actually for all the panel, not because I think the solution may come from any one of you seven. Do you have an example of a mechanism? Because I think this is an innovation in finance from the finance that is given in international cooperation for enhancing private sector participating in the finance of agriculture adaptation. Because the problem is that all the finance is being given to countries. The GEF is given to the countries. World Bank is given to the countries. The Green Climate Fund now is deciding, but mostly is given to the countries. The part, what is the private sector facility of the GCF is not running still. And since the COP21, we were talking about the need of adaptation, and that without the participation of the private sector, we'll never be able to tackle. So where are the financial mechanisms enhancing private sector participation?
Tough question to answer, that one, probably. We've got a gentleman at the back there and a gentleman at the front. Whoever gets the mic first. I think at the back.
Thank you, Madam Facilitator. My name is Justice from Southern Africa Climate Change Coalition. I've got a cause of concern. Number one, what our farmers need, one is to, I think our donors have to know that we need capacity building and development. Because as it is right now, we can talk of financing the climate smart agriculture, but as long as we don't build the capacity of our smallholder farmers and also raise awareness of the climate smart agriculture, what is it all about? What kind of an animal are we talking about? How do we go about the whole issue, right? This is the kind of thing that we really need for now. And also, there's a lady who spoke about the research, right? Is the research in the local context? Is it done together with the farmers? As long as you do research without the farmers, it's not for us farmers. What we need is help us, teach us to fish, to catch the fish, teach us to do research in our own context as farmers. As long as you don't actually teach us to do our own researches, it will be very difficult for us to, the uptake will be very low, right? Then the second issue, when we're actually doing the research, right? We need information on how to use, maybe say, equipment to actually test our soils. Whether it is experts come and actually do the test and they go. But the challenge remains with the farmer, right? How then do we use the equipment? Do we have the equipment to test the soils? Whether if the soils are fit for, a variety of crops that we actually grow in our own farms. So we need also to capacity building along those lines to say, well, how do we use the equipment to test our own soils, right? Then the other issue that we have actually noticed is there is an information knowledge gap. We don't have the much needed information. You are talking about, climate smart agriculture at the highest level. You are talking of finances at the highest level, but we are leaving out the most important, person, the community, the citizen. Does he know? Because these negotiations, they actually happen at the highest level, but is the information reaching the intended beneficiaries? How then can we make sure that that information reaches the intended beneficiary? And then finally, finance is very critical, right? And I wanted to maybe to find out the role of the civil society organizations. We work with communities. What role are we going to play as civil society organizations in this discourse? Thank you so much.
Thanks very much. Those are very pertinent points about helping farmers at the local level, and is the money really trickling down? Is the information trickling down? Yeah, we shall let our panelists come back on that. So we've got a final question here.
Thank you. Robert Gibson, living in Hong Kong. Does anyone on the panel attempt to fair value the public support for climate finance? One looks at the numbers and it seems that what happens is grants and loans are added up as though a dollar grant is the same thing as a dollar loan. Further, there is no differentiation that one can see between a loan that's made to a very high risk case, maybe for very good reasons because it's an important thing to support, and a loan that is made basically on commercial terms and therefore has no net public support.
Okay, so maybe I can ask our second set of panelists to maybe address the question at the back. Do you think that climate finance and support for farmers is going down to the local level enough? Is capacity actually being built with this money? Yeah, Marguerite.
Yes, well, in the case of IFAD, I think that everything we do is for small holders. Everything, absolutely everything how we invest in the rural areas is really trickling down to communities. And we give preference to farmer associations because when a group of farmers require a tractor, then they can share the tractor between 25 or 30 or 50 farmers. So for us, although we do all the negotiation with the governments, part of our discussion in the design process is really to involve the communities. Regarding the research, you are totally right. If we didn't do the research, which we do with the research institutions at the national and regional level, it has to be with the communities on what the communities need. So, for example, when we are developing the tolerant cassava seeds for drought for Mozambique, is with the farmers in Mozambique, for the farmers in Mozambique, that we are paying the research institutions to develop these new crops for rice, for maize, for potatoes. So all that work we are doing is with the farmers. And then the farmers are the labs where we test if this is working or not. On the information, yes, I think you are right. We need to continue making our efforts. We work in the case of IFAD in very remote areas where it's not easy to get information to, but we work with our beneficiaries in those remote areas. But just 2 weeks ago, we had a meeting of beneficiaries sharing information all over Africa and Rwanda. And that brings the beneficiaries to share their experiences and their problems, art and challenges, but also the solutions. But okay, that was our first effort to do this kind of exchange between beneficiaries. And after the experience we had, we are convinced that we need to promote more and more these kind of events.
Sounds sensible. Anybody else like to answer on that one?
Maybe just to say from our side that I think your point is well taken. I mean, the point is that you don't have enough of what you need in terms of capacity transfer, in terms of ability to manage information and receive this information at the appropriate time and so on. This is the challenge. The challenge is the pertinence of the intervention and the scale of the intervention. So we recognize that. What I can say is that from our point of view, the World Food Program, when let's say we have changed very significantly the way we've been doing business. Much of our work today is actually not only trying to meet immediate needs, but also incentivizing local markets, incentivizing the production by local farmers, bringing together farmers into cooperative, following models that have been, developed by partners like IFAD and FAO, connecting our interventions to local economies with a view to engaging people in productive processes. Fundamentally is intervening with a view to create productive safety nets that leave behind something when the crisis is over. So is that the answer? Is part of the answer. I don't think that we have at the moment in place the systems that are sufficient to meet the scale of the challenge. And I think that is the issue we need to, work on much more efficiently. Thanks.
Okay, thanks. I think let's move on to the question about mechanisms for channeling private finance to adaptation, which is kind of the holy grail. Everyone says it needs to be done, but quite frankly, beyond insurance, which is something that we have talked about already and which is often talked about by donors, what is there out there, or what is promising as a kind of, apart from insurance, as a way of getting the private sector to put more money into adaptation, which is what farmers need? Yeah, Margarita?
Yes, well, we have a lot of experience in particular with green value chains. And for us, that has helped us a lot to work with the private sector. So for example, in Sao Tome, we help the smallholders to certify cocoa. They produce it in a way that is certifiable. And then we reach to the market in Europe to certain chocolate producer, which I will not name, to guarantee that they will buy all the certified cocoa that Sao Tome will produce. The same, we have similar cases with, for example, the tomatoes in Egypt, all bought by another food company, or in El Salvador, or the olive oil from Morocco. So basically what we are trying to do is make sure that the produce is produced in such a way that will be attractive to these companies that are selling in the markets, in the European markets, for example, certified organic produce. So it's still slow, but at least that way we are linking with the private sector.
Nick, I'm just interested to know if the UNEP inquiry threw any light on that area.
Well, two things. We've actually started two areas of work, which I'd really like to hear the colleagues on that side of the room talk about. Firstly, is actually trying to go beyond the energy economy into the agriculture and forest economy, and two angles to that. One is, where can financial regulation support this process? There is a very mixed record of policy-directed lending in many developing countries. Some has been quite useful, some has been catastrophic. Can we identify areas where you can direct sensibly finance in this area? So that's one. The second is perhaps the use of financial technology. And we can get very excited about financial technology, mobile banking, and so on. But we see there is a huge potential for that to overcome some of the distance aspects that have been talked about. And I'd be very interested to see from World Food Program, FAO, and IFAD, the way in which financial technology can improve the access to finance. Thank you.
Does anyone else have any views on how we get the private sector into adaptation? Thanks.
Yeah, I'd give you an example, I think, of where we've got a good convergence between IFC, our private sector arm, Biocarbon Fund and Nespresso, where in Kenya and Ethiopia, we've put money into that so they can start to invest in a sustainable supply chain for coffee. So, you know, these things can be done. The Biocarbon Fund has also worked with Mondelez in Côte d'Ivoire. There's actually a really good case study of reforestation of a country. I mean, it was decimated, and they've done a very good job of replanting Côte d'Ivoire. And there's, I think, 800,000 smallholders who've benefited from a sustainable cocoa supply chain and the investment in that. And you know, these are good projects, and they can be scaled up and applied elsewhere.
Thanks very much. On the third question, I'm wondering whether that might be something that you could answer, Ian, or
I think I can probably give a yes.
Okay, great.
The technical answer,
Yes, please.
Robert,
That was
which is yes. I mean, this is a much studied subject, of course, and it is in the Paris Agreement as part of the $100 billion. And I think it's fair to say that it's featured in the negotiations here. And there is an expectation that there will be the finance roadmap or something like that that the Moroccans will be describing, that will actually try and put some parameters around how you quantify climate finance. Of course, you know, a dollar is a dollar, but you're right, it's remunerated in very different ways depending on how it's deployed.
Yeah, I mean, well, just so far as I know, that hasn't, it's a very good question, but so far as I know, that they haven't tried to put values on flows according to how effective or whatever they are. I mean, you know, there's a detailed report by the OECD and the Climate Policy Initiative documenting flows in 2014, but I don't think they get into distinguishing flows and trying to put different values on different types of flows. But that would certainly be a very fruitful area for future analytical work, I would think.
Yeah, definitely. It would be useful to know that kind of thing. Are there any more questions from the audience? If not, I will ask a final question to the panelists. Oh, we've got one at the back there. Okay, thanks, sir.
Thank you very much. I would like to ask about the experience of IGAD of the co-development of agricultural innovations with the farmers. We can get more information on that, and if IFAD is willing to support such initiative in the future, because there is a lot of identified best practices, but however they need some consolidation. For instance, in demonstration farms for the benefit of a great number of farmers. So thank you.
Do you know of any interesting initiatives out there that are trying to sort of consolidate the learning, the tools, the information that farmers can easily tap into? Or are there any great plans for doing such a thing? How can farmers get hold of climate finance?
I didn't really hear, where is he from?
Sorry, could you repeat that, please? We didn't hear, it's a bit...
My name is Tariq Al-Jamri from Sudan. Now I am coordinating the climate change adaptation project. I am also bringing with me some photos on the best practices of our project. Actually, I'm worried how these best practices could be upscaled and how we can convince farmers to adopt such best practices. And thanks to IFAD is doing a lot for our country. My question is, IFAD is willing to support such initiative in the future. And if I want to have more information in the IFAD experience in that, how can I get that information? Thank you very much.
One for you then.
Okay, so yes, we, of course, as you said, we work a lot with Sudan on these aspects. And we are, at this time, as I mentioned earlier, trying to start linking the smallholders that have interesting best practices to share with other. So we have a booth outside, just very near us, and you can leave your details with us. We can put you in touch with our knowledge management team, which are the ones that are now trying to collect these experiences so that we can share them in a platform with an open platform with the CCAFs from the CGR, so that everybody has access to these best practices. Thank you.
Okay, great. I think we have one more question.
Okay.
Sorry, I didn't see it.
Okay, thank you.
Ah, yes, okay, hi.
Thank you very much. My name is Sumaya Abdoun from Sudan. I work for Forest National Corporation under the umbrella of Ministry of Agriculture and Forestry. Thank you for the minister and this chance. I am highly concerned with the climate finance for the forestry sector, because forestry emission the emission from the forestry of the greenhouse gas is calculated to about 20% of the contribute to global warming. And we need a sustainable, innovative climate finance to address the degradation and deforestation in the forest. And I would like to share with you one of the initiatives launched by the International Finance Corporation, which is called the Forest Bonds. The Forest Bond will channel funds to a private sector project that create viable alternatives to deforestation. The project follows the reducing emissions from deforestation and forest degradation, which is called REDD+ schemes, offering economic incentives to reduce deforestation and to invest in low carbon growth. Investors in the International Finance Corporation they invest in low carbon growth and choose between a cash or carbon credit coupon. If they elect the carbon credit coupon, they can retire the credits to offset corporate greenhouse gases emissions or sell them on the carbon market. A price support mechanism ensures that the project can sell the necessary amount of verified carbon units until the bond matures. I am also, this is very important because in accordance to the REDD+ project to have access to the global carbon credits or finance to enable communities to have access to these credits or revenues. In terms of the CDM modality is, as we know, it is no longer effective or functioning, and how to enable them to have access to voluntary market so as to enable them to restore with us our degraded land. Thank you so much.
Okay, yes, it's a good point. We haven't discussed so much the forest sector here tonight, but would anyone like to come back on that? How can we get more money into forest protection, given that REDD+ has been moving quite slowly and it's not clear quite how that's going to go forward?
Yeah, just very quickly and specifically, you may want to look at the IFC forest bond that was launched yesterday, I think it was, and that's, I think it's for Kenya, but it services its debts with carbon credits and basically gets an underwriting of the carbon price by BHP Billiton, which uses it for its corporate social responsibility.
Okay, that sounds very innovative. Yeah.
Yeah, just on forests. I mean, I think we'd recommend countries consider the possibility of sort of like tax subsidy schemes. So you measure the stored carbon in forests at the moment through a satellite, a combination of satellite, on the ground sampling of tree species, maybe some aerial photography is needed as well. But countries are developing inventories of stored carbon, which they can revisit, say, remeasure every few years and so on. So we would recommend national level tax subsidy schemes where you tax landowners who have cut down forests and reduced stored carbon relative to stored carbon in some baseline year, but then you subsidize landowners who are expanding forest or changing forest management practices to increase the amount of stored carbon. And you can design these schemes to be roughly revenue neutral, so you can scale them up. You can provide incentives across the whole country to increase stored carbon. And you don't have this problem with red type programs where you can't make any progress without putting more money in. It's sort of like there's a limit to these project-based programs, just purely from a budgetary perspective. In addition, if you're having a national level program, you don't need to worry about measuring whether individual projects are additional or not. You just measure, well, has your stored carbon in this parcel of land, has it increased relative to that in the baseline? If so, we'll give you a subsidy. If it's fallen, then you're liable for a tax. So we think these sorts of schemes are promising. They haven't been enacted yet, but we think there are these schemes are promising. In addition, they avoid the problem of leakage within a particular country, because you're taking a national level perspective with a project by project approach. There's always the risk that you might increase forest coverage in one parcel of land, but it might be offset by forest clearance elsewhere. So the tax subsidy approach imposed at the national level deals with these three problems with a project by project funding approach.
Excellent. I think we've heard some really interesting ideas there. I'm just, journalists always like asking the last question. So I just wanted to ask the panelists very quickly, as in, you can give a 30-second answer, just to bring the two elements of what we have up here on the screen together. In order to fulfill the SDGs, to meet those targets, those goals by 2030. I'd just like you to give a very brief view on what you think needs to happen in terms of building the rule book for the Paris Agreement, in order to make finance flow fast enough into the right places so that we can hit those SDGs as we're supposed to. So I'd just be interested if you could give me a brief view on that, and then we'll finish for the evening. Sorry if that's a bit of a tough question this time in the evening, but I just thought it would be good to get finally get the creative juices flowing before we leave the room. So who would like to start? We don't have to go in order.
First, we need to look at the banking sector. That's the most relevant sector for most economies, particularly developing economies. And we need to properly identify where bank loans are linked to green or low carbon activities, and where they're linked to high carbon and high resource activities. So we need to take the energy out of the green bond market and push it upstream into the banking market. If by 2020 we can actually have an agreed system for tagging loans, then I think we'll make a good progress. Then the step is actually how we provide incentives, either fiscal or regulatory, to encourage more flows towards green finance. And on the bonds question that was mentioned, I think it's very important to recognize that bonds are very low risk financing instruments, and you need to have very secure revenue streams to pay for them, either fiscal, carbon markets, or commercial, and not to pay for potentially high risk innovative activities.
Who's next?
From a completely different angle, I think one factor that would help change the scene is a much stronger involvement of global public opinion around the issue of climate change through a much better understanding and visualization of what the impact of that is going to be in the short run.
Who's next? James.
I'd say the great success about the Millennium Development Goals and potentially the Sustainable Development Goals is measurement. And I think putting in the kind of measurement that enables us to make better decisions and allocate finance more effectively would enable us to track the implementation of the SDGs, but also get the finance to flow in the way that's going to give biggest bang for the buck.
Fantastic. Okay.
For me, it's to acknowledge that finance, and in particular private finance, flows on many, many different levels. So there's no one private climate finance. When looking from my perspective, it's large-scale institutional investors finance. Then it's two things. It's one, a business case, and then this can be achieved by enacting real economy relevant regulation or frameworks. And when it comes to the financial sector itself, it already follows, or it's already tightly regulated. And you can think about green regulation broadly based. It's nothing new, it can be done.
Conrad, perhaps?
Well, from our perspective, we think that it's not so much a question of the total quantum, but using the finance available in a more catalytic way. As I said, the investments, particularly in the agricultural sectors, have the potential to deliver a whole range of benefits, adaptation, resilience, but also productivity, so financial benefits as well.
Well, just zooming in on one aspect, and that is scaling up finance for adaptation in climate vulnerable countries like small island developing states. I mean, I think they have high needs, but at the moment, I think there is severe administrative burdens and unclear rules for disbursement of the funds, which are holding back a lot of potential funding for these countries. So just clarifying the rules for how, say, funds from the Green Climate Fund will be allocated for adaptation would help. Cutting back on administration, cutting back on sort of middle men to make sure that more of the funds are actually, you don't lose a lot of the funding in sort of like paying for middlemen. And then in addition, thinking about, well, I think only about 14% of climate finance is going to adaptation at the moment. So should we be thinking about increasing that fraction and scaling back the fraction for mitigation somewhat? But I think, and then also helping small island developing states become more receptive to the financing in terms of developing sound macro fiscal frameworks, which will help the incoming funds be more productive and hopefully leverage more private flows.
Margarita, last word to you.
Yes, going back to what James said earlier, making sure that it's clearly understood what we are losing by not investing in climate. The 100 million people that will return to poverty. How many of our investments, millions of dollars of investment in agriculture will be lost if we don't take into account climate and we don't invest in climate?
Okay, thank you very much indeed to all our panel, and that's quite a lot of people. So I think we've had a fantastic range of ideas. I think from what I'm hearing, we understand the problem very well. We know where the need is. We know that we urgently need finance. Also, there are a lot of ideas for how to get that finance, both flowing more to the low carbon climate resilient area and also, you know, to people, to individual farmers, to the farm level. But it seems that a lot more things need to be tested, more connections need to be made. Needs to be more confidence. Some of the problems need to be hammered out, definitions, understandings, shared experiences. So obviously there's a lot of exciting work to do in the coming years, but I think this is still an open question whether we're going to get there in time or not in order to keep those farmers producing the food that we need for the world to end hunger and end poverty. Thank you very much indeed, everybody. And I'm sure you would all like to go home now. Thanks ever so much.